Morning, folks, or afternoon, depending on where you're joining. We'll give everyone just a couple moments to get settled. We have a very big turnout. Surprisingly enough, we have more turnout for the tax discussion than we do for the market update, but we won't read too much into that. But thanks again for giving us some time this afternoon. Again, like I said, we'll get started in just probably a moment or two. People trickling in, that's great. All right. Let's dive in. We've got a full agenda for today. I'll have Tom take us through the real agenda in a minute. But let me introduce myself. I'm Jeff Hansen, the founding member of Breakwater Capital Group. We've been around for almost 2.5 years. Madeline and Tom are also instrumental players within the organization. They're going to probably spend more time talking today than I will, which is a treat for everybody. But we wanted to spend, probably a good 45 minutes to an hour together as we wind down 2024 with a focus on taxes. And most of that energy is spent in the first quarter compiling your records, getting it off to your accountant. But the world of tax is dynamic. It's really something that should be thought about throughout the year, which is what we're doing on behalf of our clients. But we also ask our clients to really think a lot about what's going on the way away from us, right? We may have different moving parts of their lives that are important for us to better understand. So again, this should be pretty encompassing, maybe inch deep, but a very wide net. And we would look to really spend some more time with each individual and their personal circumstances. Again, just a little more breakwater. We've been around, again, a little bit under 3 years. We manage assets for about 300 families, about 800 million in assets, mostly individuals, but some institutions as well. We are in northern New Jersey, where I'm headquartered, Dedham, Massachusetts, where Tom is, and then in Denver, Colorado, where Maddie is. We'll be very clear to indicate we are not accountants. This is educational in nature. You'll see some fine print throughout the slides, but hopefully, again, you'll come away from this discussion much more informed. So, Tom, let me turn it over to you. You'll kick us off, take us through the agenda, and you'll get into the meat of the discussion today.
Great. Thank you so much, Jeff. I appreciate it. And we do have a action-packed agenda. Even though it is taxes, it's action-packed. As far as just what we're covering, we are starting with foundational tax planning, tax credits, Roth conversions, qualified charitable distributions, donor advised funds, tax smart investment strategies, and small business strategies. So action-packed. I'm going to kick it off really with the foundational tax planning, some of the tax credits. I'll pass it off to Maddie, and then Jeff will take us home with the last couple of topics. Maddie, if you don't mind jumping to the next slide, I would appreciate it. So this slide is a slide that, as certified financial planners, we are very familiar with and comfortable with. These are the 2024 annual limits relating to financial planning. So as you look at really any numbers on the screen, most of the time these numbers are changing year over year to adjust for inflation. But it takes us from anywhere from 401k, 403b, 457 contribution limits, Roth IRA, phase outs, single, married, really just health savings accounts, the full gamut. So this is something the College of Financial Planning does update every year, send out to us. And as we talk about foundational tax planning, these are numbers that are very important to us. And as we think about strategies for each one of you, all of our clients, it gives us the ability to look at it, figure out, again, where do you fall now? What opportunities do we have to be a little strategic with your tax situation? Thank you, Maddie. On this slide, to protect the innocent, we have Joan Smith here, who is a fictional taxpayer, and just a few key numbers that I want to make sure that we do cover. A few of these we will be going and mentioning throughout the presentation. total income, AGI, which is adjusted gross income, AGI, modified adjusted gross income. So we will cover those numbers. In this particular slide, we've got the total tax someone paid, their filing status, the marginal tax bracket, their actual average rate. So I want to call out the two different, the bottom of the left-hand column, the top right of the right-hand column, the average tax rate, also just carry forward losses, short-term gains, long-term gains. These are all things that are very important to us as we manage a portfolio and also talk through a tax situation with a client. Maddie, if you could, thank you. So on this first slide, the big key, and I know a lot of clients know this, some clients don't, very often we're getting all our tax documents from our employer or from the brokerage firm that holds our investments, and we're taking them and handing them to an accountant. And when we look at ordinary income, we do pay different tax depending on what our income is. And if you look at this marginal tax bracket in this hypothetical situation where we've got $67,000, if you look at down at the total at the bottom of ordinary income, the first 11,000 in that top row, you pay 10% tax on. The next, in this case, 33,725, you're paying 12% tax on that amount of income and 22% tax on that 22,379. And so based on that breakdown of taxes, that's where in the last slide where we looked at the average rate. So this client would pay an average rate of 12.4% because of how their income falls into those tax brackets. So not every dollar is going to be taxed at that highest marginal rate. And whenever you start to see an average rate, your accountant might provide that to you, or if you're doing your own taxes, you might see that number. This is essentially the breakdown that happens with everyone. Their numbers just slot in depending on how much money you make, either individually or as a couple in your particular family. So on the next slide, we always like to point out, just as far as long-term capital gains and qualified dividends, what is the rate that you're actually paying as it relates to those? And if you're on the border of, say, 15% and zero, we're looking for opportunities to say, hey, is there anything that we can do to potentially impact how much tax you would actually pay? And also, if you're paying a very high rate, it can speak to things like, and I don't want to steal any of Jeff's thunder, but things like asset location or security selection, that type of thing. We're looking to manage that for clients. If you don't need the income, if it is something we're trying to actually minimize, then we will get into that conversation. On the next slide, we have Medicare, so Part B and D, and the premiums that you end up paying. So modified adjusted gross income is really just your adjusted gross income plus tax exempt interest for this calculation. And if you look at this particular chart, we've got, on the left-hand column, the MAIG threshold, then it gives us the actual number, and then the Part B premium as well as the Part D premium. So in each column. And again, our job is to look at it, analyze it, figure out through tax planning and through a partnership really with your accountant to look through it to say, okay, are there any things that we could do to help you minimize what you're paying as it relates to Medicare premiums? So if you look at where the 111,592 falls, they're under the Part B column, there's a $74 extra premium paid for that level of income. And if you look in the Part D column all the way to the right, there's an extra $13.70. And those are both monthly numbers, so they do add up and are, again, a component of your taxes that we want to take a look at to see if, hey, if we pull this lever or we pull that lever, is there any way to positively impact your tax situation? On the next slide, the Social Security slide, you can take a look at this table. I think is pretty interesting because the threshold for paying taxes is pretty low on Social Security. We, on the one hand, want to minimize taxes for everyone. On the other hand, we hope that everyone makes has a great level of income and you're making as much as you can, you're as comfortable as you could be, but hopefully we're going to pay as little in taxes as we legally obviously can. We want to stay within the law, no doubt about it. We would never give you any advice otherwise, but we want to make sure that we're helping to minimize that tax burden, because ultimately it is the largest fee that any of us will ever pay. As you look at this particular table, anything over $34,000, that's really the income threshold. 85% of the combined income is taxable. So the calculation just under the bar graph there goes into exactly what goes into it. So it's AGI plus the non-taxable interest, and then 50% of the Social Security benefits in this case make up that combined income. And takes us into, all right, 85% of that is ultimately going to be taxed.
One thing I'll point out too, Tom, just Maddie saying this, that's prior side. This is for based on a single individual, right? So if we think, oh, hey, married couple, these numbers would double. Not so fast, right? So looking at the last item, right, up to 85% taxable. If your income is more than $44,000, if you married filing joint, you're looking at an 85% of that, 85% of that Social Security being taxed. So just again, look, in some instances, the tax tables do almost double up, not with Social Security. It's just a modest increase over that number there, where the taxation would be at 85% of that income level. So Tom, sorry to come over the top there. I just want to call that out. This is looking at just a single filer versus married joint.
Not at all. And all of these are just examples. I think that was a really important point. So thank you for that, Jeff. But when you look at, someone's tax situation, everybody's different. It's the same as financial planning, right? All the puzzle pieces are going to fit together differently for, a couple and individual people filing married but separate versus married and joint, or had a household, versus a single filer. There's a lot of complexity that goes into it. And I think if you take anything away from this presentation, it's, if you share your returns with us and would like to go through an exercise like this, then we're going to get very individualized with your situation and be able to really do your math and look at it and say, okay, again, where are the opportunities? Where are the levers that we can pull? That's really the important thing. As we look at the next slide, with this slide, your life stage and really, kind of what you would gravitate to as it relates to potential credits. You might go to a different spot. In the middle of this list, there's the child tax credit. If you have minor children who are dependents and living with you, that would be a number that would be a very important number. If you look at qualified adoption expense, if you're looking to adopt, that's going to be the most important number. You might look at the bottom two, where we're saying, hey, if you buy a new EV, here's the threshold where you may qualify for a credit. If you're looking at a used EV, the threshold's much lower as far as the income amount. And so that might actually influence what kind of car do you get? Do you get a new car? Do you get a used car? Are you somewhere, if you look at the right-hand column, the orange, the red, and the green, are you in the middle of the phase out? Are you over the income threshold? Are you under it? What could you potentially expect for credits in really any of these categories? This is something that again, we're not going to give you specific advice and say, hey, this is the exact dollar amount, but it might give you some guidance to say, if you're going to actually buy an EV, then, the math might actually work out that you go buy a new one, because you're qualify for that credit, but under the used situation, you might not. So it might actually shift the scale and shift the math a little bit to make one version of this a little bit more attractive than the other. On the next slide, Roth being the top line there, Roth IRA contribution, what is the phase out income threshold? If you look, student loan interest deduction, again, depending on your life stage, what you're interested in, what your individual situation is, where do you fall on that? Those are really the two most popular, I would say, on this page. IRA contribution deductibility or not non-deductible contributions also on the page. Student loan is something I'll go into a little bit more depth on the next slide, but there's $1.73 trillion with a capital T outstanding student loan debt. So this is one that definitely pops up quite a lot. And I know that Maddie's going to spend a good amount of time on some Roth information, but if we jump to the next slide, the student loan interest deduction. So to go through a little bit of, the phase out and how does it work? So borrowers can deduct up to $2,500 in student loan interest. It is an above the line deduction. So that means you don't actually have to itemize your taxes to be able to take that deduction, which is a good thing. If you think of recent college graduates who have student loans, or, maybe you're a little further on, in life, you want to be able to take that deduction. And also with the tax changes that were enacted a few years ago, the threshold as far as the standard deduction went up to a degree that it eliminated a lot of itemization. So above the line deductions are very helpful and valuable. And in this case, that's really what that deduction is. It is an above the line deduction. The 1098E is the actual tax form that would come that you'd be handing to the accountant or punching into, TurboTax or whatever software you potentially use. As far as the phase outs go, so the rules are different, like an IRA is, married filing jointly, and then also single. So you can see 2,500 if your AGI is less than 155,000, then you're in a gradually reduced phase out between 155 and 185. Again, married filing jointly, filing single head of household, or qualified surviving spouse, 2,500 up to 75,000 or less. And then your deduction is reduced gradually between 75,000 and 90,000. So again, we're looking at all of these, trying to calculate it, trying to put you in the best position we can as it relates to taxes. As one more thing that we do on top of, investment management, but also kind of partnered with a lot of the financial planning that we do. So with that, I'm going to turn it over to Maddie to talk about Roth conversions.
Thanks, Tom. Being, responsible for the experience that clients have when they come to us in terms of their financial planning, this is something that I'm extremely passionate about, and making sure that all the things that Tom discussed, along with, the things that I'm going to discuss, are working together, I think is very valuable. And we wanted to take a second to show clients the mechanics of how we actually put these things together, because these numbers don't just come out of the sky here. And they're very specific to each person's plan and what their goals are. So to start off with here, the Roth conversion process is the process of transferring money from a traditional IRA, where contributions are pre-tax, into typically a Roth IRA, which allows for tax-free growth. And certainly during the conversion process, taxes are paid on the amount moved, effectively transitioning funds into an account that will grow tax-free into the future. The benefits of a Roth conversion certainly can be compelling. First, we have tax-free growth, which means that once those assets are converted, all future growth and qualified withdrawals are tax-free. Second, Roth IRAs don't have a required minimum distribution, which provides a little bit more control over the distributions that clients want to make versus what they're forced to take. And certainly there can also be an estate planning advantage, something that we talk about a lot with our clients. Roth IRA accounts can be an effective asset to pass on to beneficiaries, as those are tax-free assets versus taxable assets. And if you're self-funding, another thing that we talk about with clients, given the cost of long-term care insurance, if clients have enough assets to self-fund that care, should they need it, Roth IRA is certainly an effective tool in which to use to cover those funds, because that may avoid paying higher possible taxes on Social Security, like Tom showed, Medicare premiums, versus if you were to take them out of a pre-tax asset like a traditional IRA. And Roth conversions can make sense depending on what different stage you are in life, as especially beneficial for certain age groups. If we look at younger investors, typically those between 20 and 40, it makes sense if they're in a lower tax bracket to contribute directly to that Roth IRA if they're below the phase out limit. And typically what we like to see for that is clients who their top marginal bracket is 24, 22% or less. For ages 55 to 72, conversions can help reduce required minimum distributions by shifting those pre-tax dollars to Roth IRAs before 73 or 75, depending on what age their required minimum distribution has to start at. And for older retirees, those ages 73 and up, required minimum distribution age and up, Roth conversions certainly can play a key role in distributing those assets and planning their estate, especially with combined strategies like charitable giving and annual gifting limits to family or charity that we're going to be talking through here. So to start out with, this slide in particular highlights an important but certainly often overlooked aspect of tax deferred accounts. And this is something that we walk through with clients individually. And so some of the assumptions that I'm going to be using for this particular example of clients are listed above here. So we have a client who has total taxable assets of a little under $1 million, tax deferred assets combined between both spouses of 2.3 million, Roth IRA assets of 143,000. We are suggesting a conversion of 37,000, and the taxes on the conversion, that 8140 is right below. We're assuming a rate of return of 8% and inflation at 2%. So those are going to be the assumptions that we're going to go with through these next few slides as an illustrative example. And we're just going to call these clients John and Jane Doe, a little bit different than the example that Tom used before. But if we look at these tax deferred assets in this top box, it's always essential to remember that although that IRA balance comes up across your net worth line, it's not entirely yours. The portion that is effectively, there is a portion in there that is effectively owned by the government in the form of future taxes. And you can see that broken out there. That's that 565. And the initial tax deferred balance of 2.3 million, again, that 565 is projected to go towards paying taxes. This particular example, that these clients are in the 24% bracket. So they're leaving 1.7 million untouched, but that tax liability doesn't remain static, right? So just because it's 565 today doesn't mean it's going to be 565 in the future. As your account grows, that tax liability will also grow. And so after 4 years with growth factored in, the account reaches about 3.2 million. The tax liability has increased to 769,000, or another way of looking at that is the tax liability has grown by about 27%. So again, this slide illustrates the tax impact on tax deferred accounts growing alongside the account balance, meaning the more that your account grows, the larger your future tax bill could be. And so if we're looking at ways of avoiding that, we're going to look at, okay, well, if we suggest Roth conversions for our clients, does that add value over time to the overall portfolio? And that's what this slide is looking at here. So each one of these bars is 1 year in the client's life until they turn age 100. And you can see if we're converting $37,000 every year for the next 6 years until John turns required minimum distribution age in 2031. And we chose that 37,000 because that will mean that he has converted essentially 10% of their pre-tax assets, but also kept them under that Medicare premium threshold, or at least one of those thresholds that Tom had discussed earlier. So again, it's not one thing or another, it's a combination of all these things. And like I said before, each one of the bars here is 1 year in the life of the Doe's family until each of them reach 100. Ensuring longevity and financial security have both been addressed first and foremost, and that's their assets are lasting as long as they do. If we don't convert anything, their portfolio is shown in the dark blue bars. But if we process the conversions, those you can see what's added to the overall portfolio value in green. So projected over their lifetime, the conversions are projected to add about $600,000 to the overall net worth. And in the bottom, you can see that breakdown in their portfolio value and the net worth increases. So certainly this would indicate to us that Roth conversions would be worth their while. The next way that we look at this is through their estate plan, because like I said in the beginning, Roth conversions can be an effective tool for estate planning as well. And so if we look at this estate planning flow chart, we want to make sure that John and Jane Doe here will effectively remove more from their estate tax than the income tax with inside their estate than they would have paid by the time they reach required minimum distribution age of 73 in 2031. And so the estate planning flow chart breaks those numbers down. The top box separates their individual net worths, with the first arrow showing what happens if one of them passes and what happens if both of them pass in the bottom set of boxes. The total taxes due without doing the conversions is $693,909, mostly due to that stretch IRA. You know, Tom had referred to rules changing in the past few years. This is one of those rules. So the stretch IRA rules, instead of stretching it out over the beneficiary's lifetime, now it's compacted into 10 years. So it increases those income taxes due on those pre-tax assets. And so the kids will need to distribute the pre-tax assets over 10 years. Inevitably, that will push them into a higher tax bracket. So now they're forced to take over $300,000 in distributions annually for 10 years, based on the pre-tax assets being 3.5 million in 2031. And so we want to make sure that that 693 goes down by the time they turn 73. And so that's this example here. So we have to look at how that changes their estate taxes if they do the $37,000 in conversions for 6 years, again, by the time they reach minimum required distribution age. Those Roth conversions will effectively have lowered their taxes by a little over $72,000, because in the previous slide, their total tax was $693,000. And now you can see the bottom number on the left-hand side is $621,000. So again, removing $72,000 in income tax by processing those Roth conversions. And also remembering that the conversions will have added $600,000 to the overall net worth, and removing $72,000 in income tax from their estate by the time they hit required minimum distribution age in 2031. So on the next slide, we're going to be talking about making sure that they have removed more income tax from their estate than they paid up until this point to process the conversions. And so this breaks down exactly how much they're going to owe if we start these conversions this year. And so based on the Doe's specific tax projection, it's going to cost them $8,100 for the next 7 years if their situation pretty much stays static. And we know that it pretty much will, because their lifestyle isn't going to change dramatically. So they will have paid a total of $56,980 in taxes to make those conversions total. But remember, we've removed $72,000 in income tax by the time they turn required minimum distribution age. So effectively, we've removed more taxes than they've paid to do these conversions. And this is, again, assuming that they're in a 24% tax bracket. So all in all, that number tells us that those conversions will be more valuable over time. But again, up until the time they turn 73, those conversions will pretty much already have paid for themselves. And the last thing that we want to look at with Roth conversions, and there's a lot of numbers on this page, I'm going to ask you to pay attention to the planned distributions, because that is going to be the required minimum distributions for the Does. And so you can see that by the time they turn 73, their required minimum distribution without doing the conversions is $102,000. If we look at the planned distributions on the right here, that's $88,000. So we will effectively have lowered their required minimum distribution by 13%, decreasing from the 102 to the 88,000. And these conversions have also taken into consideration that we don't want them to pay an increased premium for Medicare. And so we've saved them about $2,500 in additional IRMAA taxes by lowering their required minimum distribution. So all in all, for this example, we've added $600,000 in total net worth. We've removed $72,000 from income tax and estate planning, and it's cost them almost $57,000 in making those conversions. So we've removed more tax than we've paid, which is a great thing, and we've made sure that they're not paying any premiums for Medicare, any more premiums, excuse me, for Medicare. And the longer they live, the more these conversions will save them in taxes, because those assets grow tax-free. So now if we look at, okay, well, it's not just Roth conversions. We want to look at the total client tax return. So if we do that, we know that some clients are looking to make sure that the money that they're giving to charity is made in the most effective way possible. And so we can't talk about Roth conversions without talking about qualified charitable distributions, especially for clients who are required minimum distribution age. And so based on the return, or having a conversation with our clients, we may suggest that they give via qualified charitable distribution, or QCD, as they're called. QCDs are available to IRA holders who are over the age of 70 and a half. It allows them to make a tax-free distribution directly from their IRA to a qualified charity. The main advantage of a QCD is that it bypasses ordinary income tax. Unlike other IRA distributions, this can be definitely beneficial for retirees looking to manage their taxable income while supporting charitable causes. To be eligible, there are a few important rules to follow. So first, the taxpayer must be at least 70 and a half years old at the time of distribution, and the distribution must come from a traditional IRA or rollover IRA. The charity must be a qualified charity, so contributions to donor-advised funds or private foundations do not qualify for a QCD. The maximum QCD amount is $100,000 per person per year. Under the Secure Act 2.0, that will now be indexed to inflation starting this year in 2024. And by understanding the eligibility rules, IRA holders over 70 and a half can certainly effectively use QCDs to fulfill their charitable goals in the most tax efficient way. And the next thing that we wanted to talk about was why QCDs may be better than itemizing charitable donations, especially if you're already making those charitable donations. And so one of the main benefits of QCDs are that in some cases it can reduce taxable Social Security income. It lowers the modified adjusted gross income. The modified adjusted gross income can also affect eligibility for various credits that Tom went over. So if we can use this to push you back down to be able to use one of those credits, great. Or reduce your exposure to net investment income tax, which is that 3.8%. A QCD is something that can help you reduce your income, and certainly can also help you reduce any premiums that you may be paying, any IRMAA premiums that you may be paying for Part B or Part D, trying to lower that high cost of healthcare. The first Medicare premium threshold is $206,000 for a married couple, $103,000 for a single filer. So this is a crucial tool that we use in possibly avoiding those surcharges. It also potentially allows for more of one's itemized medical expenses to be deducted, providing further savings, because your medical expenses have to be at least 7.5% of what your AGI is in order to be able to deduct those expenses. The standard deduction is now higher, as Tom told us in the beginning, so many taxpayers can't itemize anymore. With a QCD, this is something that you can still benefit from charitable contributions without needing to itemize those deductions. QCDs count towards your required minimum distributions, making them a more tax efficient way to satisfy those requirements while still continuing your ongoing charitable support. So certainly overall, QCDs offer a range of benefits that go beyond traditional itemized deductions, and that makes them an effective strategy for us to implement with clients. And so how do QCDs work? So we wanted to go over some of the main points of QCDs here. The funds must go directly from your IRA to the charity. So if the distribution goes to you first, let's say you take a distribution from your IRA, you put it into the bank account, and then you want to do a QCD, you cannot do that. It will not count. The check, if you request it from your custodian, can be mailed to you, and you can go personally deliver that check so the charity knows it is from you, but it has to be made out to the charity already. It's also important to know that IRA custodians typically report the QCD as taxable on the 1099-R. So it's up to you and your tax preparer to make sure that they are listed as tax-free to ensure the proper reporting. This is another reason why we are very adamant about collecting clients' tax returns, because we know if we've made a QCD with them, it's a very easy error for us to catch and make sure that it's filed properly. Another option you may have is obtaining, you don't see this as often anymore, but you may be able to get a dedicated checkbook from your IRA custodian, allowing you to write checks directly to charities from your IRA. But those can get confusing, especially if they're mixed with other purposes. And remember that charitable contributions from QCDs cannot be itemized on your tax return. Doing so would be essentially doubling the contribution, definitely would lead to inaccuracies on the 1040. So we just want to make sure that these QCDs are properly reported to make sure that your charitable giving is efficient and effective. And how we do this with clients, this is how we break down clients' specific recommendations. We run sample projections based on their previous tax returns and project into the future. So if we're choosing to donate via QCD instead of taking a taxable IRA distribution with an itemized charitable deduction, your bill could be reduced by, the example shown here is $2,697. For this example, we're showing a $15,000 qualified charitable distribution for the year. With the QCD and the adjusted gross income is slightly lower, allowing for lower taxable income and resulting in a reduced tax bill, even with the client being able to itemize their deductions. So we wanted to show you, even if you do itemize your deduction and let's say it's $35,000 and the QCD pushes you back into making a standard deduction, well, your overall tax bill is still lower. It goes from almost $38,000 to $35,000, saving you this $2,697. So we always run these projections for clients to make sure that they're, doing things as efficiently as possible. On that same note, we wanted to also discuss donor advised funds for those, especially for those not able to make a qualified charitable distribution because of their age or whatever the case may be is. This is another option that we talk about with clients often. Donor advised fund, or DAF, as they're often referred to, certainly a powerful tool for maximizing tax benefits of charitable giving. With the donor advised fund, you can take multiple years worth of deductions into a single year. We refer to that as bunching your contributions, which can be especially advantageous for further tax planning, given that these SALT deductions have been capped. With a donor advised funds, you can contribute cash, stocks, other assets to your donor advised fund and receive the tax deduction for the donation in that year. So oftentimes when we see clients come to us with concentrated positions because they've worked for a company for a long time, they get paid in stock or whatever the case may be, this is an effective tool to meet their charitable giving, but also for us to be able to rebalance their account in a more appropriate way without causing a big tax liability, because the underlying gains in that position tend to be quite high. The donor advised fund can be invested and grow tax-free over time. So then at any point you can recommend grants from your donor advised fund to choose to different charities of your choosing, spreading across your charitable giving over several years. So if you're used to giving $5,000 a year to whatever, cause you feel strongly about, you can still continue to do that, but you've effectively taken advantage of 1 year's worth of, you can put in $20,000 in 1 year and still give out the $5,000 a year, but now you've gotten some credit for actually making that $20,000 contribution to the donor advised fund. So there's a lot of flexibility there, and it makes the donor advised fund an excellent option for those who want to manage their charitable contributions and also optimize their tax situation. So how is the donor advised fund helpful? With the donor advised fund, you can take charitable deductions in the year that you contribute, even if you distribute those funds to charity over different years, as I was just referring to. The donor advised fund allows you to donate appreciated assets that may be difficult for some charities to accept directly, like proprietary funds or some more complex securities that custodians are used to dealing with. You'll need one receipt from your donor advised fund contribution, which simplifies reporting compared to collecting multiple receipts for individual donations. So again, instead of collecting your $25 donation here and your $50 donation there, you get one receipt from the donor advised fund, which should be hopefully a little bit easier for you to manage at the end of the year, and certainly your tax preparer to manage as well. I do see a question. I promise we will get those addressed at the end here. But just wanted to make sure that client knew that we were paying attention. Another donor advised fund benefit is that it allows anonymous donations, which can help you avoiding ending up on unwanted mailing lists. And you can contribute appreciated stock to a donor advised fund, as I was referring to earlier, and make smaller grants from it. And that's often a more tax efficient and manageable than donating single shares directly to multiple different charities. And how do we do this with clients? Again, a lot of numbers on this page, but we look at clients, each one of these columns is one different year. And so, like we said in the beginning, we run tax projections for clients. And so we want to look at what their itemized deductions are on Schedule A. So this is a breakdown of what they may look like for any individual client. Of course, this is just an example. So the breakdown shows different categories of deductions like state and local interest, mortgage interest, charitable contributions, and some more buckets there. Our goal is to make sure that these categories are carefully looked at to optimize your specific deductions, ensure that you're capturing the maximum benefit. So we've highlighted the charitable deduction strategy here with an emphasis on contributions that end up to optimally maximize their deduction amount. So by comparing itemized deductions to the standard deduction, we can determine which one will be most appropriate for you with the best taxable outcome. And this is part of the detailed analysis that we provide to clients, hopefully highlighting our commitment to finding the most tax efficient strategy for them and actually putting numbers to paper here. So we look at, what does it look like if we donate, a specific amount to get us over the hump of not being able to itemize our deductions. And if we have a one-off income event in a specific year, a donor advised fund can be a strategy to circumvent that. If we are doing a Roth conversion, or if your income significantly increases in 1 year because of a bonus or whatever the case may be, donor advised funds are certainly a strategy to try and circumvent as much, shielding as much tax as legally possible. And so higher income tax due to unusual events contributing to a donor advised fund, we highlight that even more depending on what's going on with the client. But with a donor advised fund, in this particular example, the total tax would be $41,392. But if we do make those contributions to the donor advised fund, we increase the deduction amount, lowering the taxable income. And that brings the total tax down to $35,035, resulting in tax savings of $6,357, the difference between these two numbers here. And so again, using a donor advised fund in a high income year certainly can be an effective strategy to reduce your specific tax liability while continuing to support those charitable causes over time. And lastly, I will kick it back off to Jeff here to tax smart investing strategies for small businesses and considerations.
Thanks, Maddie. Appreciate it. We just spent a good amount of time giving your money away in QCDs and donor advised funds. So let's talk a little about making sure we keep it and grow it along the way. Maddie, I'll help you hop to the first page. It was just like kind of simple stuff, like basic building blocks. Fill up those tax advantage places first, right? Whether it's the 401k at work or the match contributions or your Roth IRA. We have plenty of people who are retired. I know they're the ones oftentimes joining these calls because it's the middle of a work day, but it's not uncommon. We still have people making their $7,000 or $8,000 IRA contributions to Roths while they're in their second or third career. HSA is, again, another planning tool that we just keep harping on over and over again. I know we had a wonderful event last month focusing on the annual enrollment window and utilizing the power of HSAs. So again, just make sure you take care of or take advantage of these low hanging fruit. To get a little more complex, right? There's this ongoing concept of tax drag that is important to understand, right? So tax drag is just like, hey, running a foot race with a parachute behind your back. If we can have no parachute, even spectacular, hardly an option unless we're living in a really tax-free state, and a lot of our assets are held in tax-free or tax-deferred accounts. But for those of us who live in high tax states, tax drag can be huge, right? So I'll use municipals as an example, right? So rates have gone up a lot over the last couple of years. That's a good thing. They've gone up kind of across the entire spectrum of fixed income assets. Municipal bonds a couple of years ago were yielding as little as 2%. Now, if you're looking at like a 5 or 7 year municipal bond, you might be able to get 3.25% to 3.5%. Now, someone might say, "Hey, well, a 2-year Treasury pays you 4.3." But if you're in a 24% tax bracket and you pay state tax of 6% or more, a 3.25% yield is going to be the equivalent of about 4.6 if you use a municipal bond, right? That's both federal and state exempt. So we're definitely interested in munis. There have been times in the past where municipal bonds, on an absolute basis, provide better yields than taxable bonds. Today, it's normalized back to where the absolute yields are less, but on a tax equivalent basis, those municipal bonds may in fact provide a lot more bang for your buck. ETFs versus mutual funds. I know most of us have kind of been frustrated over the years where you get a 1099 and you say, geez, I didn't sell anything, but I get this big capital gain distribution. Mutual funds are themselves pass-through entities. They don't want to pay taxes, so they're required to distribute 90% of their gains that have been realized that year, generally in the fourth quarter. Whereas ETFs, which were created much later, have essentially a tax exemption. They don't really ever sell securities. They swap securities, which means they don't realize gains, which then don't have to be passed through. So, when push comes to shove, if you've got money to deploy in a taxable account in particular, an ETF is a very efficient way to do that. Definitely towards year end, here we are fast approaching those December distributions. Don't buy a distribution, right? Like, can be one of the worst things to do is hop into the high profile growth fund just now at the end of the year. Maybe you're excited about what happened at the election, but you're going to potentially find yourselves with a tax bill for gains you didn't yourself get to reap the benefit of. Tom had alluded to this briefly before. Asset location, that's not asset allocation, which we're talking about all the time, like the ratio in stocks, bonds, and cash, but it's about like, hey, do I own the right assets in the right place? So since 2003, where the dividends and capital gains rates have really come down a lot, right? 15% for most people, maybe as high as 20%, but again, consistently much lower than ordinary income rates. Those assets are better held in a taxable account, right? Your brokerage account, your individual account, joint account, trust account, but not to say they shouldn't be in an IRA account, but if you were going to go ahead and pick one versus the other, the brokerage account is a better place to be. And the other end of the spectrum, your fixed income investments, those that own taxable bonds, so think treasuries, corporate bonds, high yield bonds, those ideally are held in that retirement account, right? Where all that ordinary income it spins out won't show up on your return not until you withdraw the funds at a later date. We want to talk about trading, right? Trading is become very popular. Really, a huge rage in 2021 in the world of meme stocks and the pandemic fueled gamification of the stock market. Seen some signs of that again, clearly, right? Bitcoin's back above 90,000. And there are a handful of stocks that have somewhat parabolic runs here. We encourage people always to be, more kind of the consistent buy and holders. But there are instances where trading can make good sense. And so, Maddie, if I'll have you hop to the next slide, just going to explain one thing that we talk a lot about amongst ourselves, maybe a little less about you. We don't necessarily go highlighting the word loss. If you invest, again, it's pretty safe to assume over time on paper, you'll have something that's in the red at one point or another. But it's taking a bad situation and making it better, right? Lemons becoming lemonade, right? So, this year it's been pretty good, right? Up and to the right. Got a couple pockets of volatility. I think the market's biggest drawdown was about 5% that took place in the summer. So last year we saw a traditional correction. 2022 we know was quite ugly for both stocks and bonds. But in any given year where the odds of a correction are pretty high, there can be an opportunity to harvest tax losses. We do that dynamically over time. We don't want to over harvest because sometimes we have enough losses in our back pocket where we'll be able to help use those efficiently in the future, but we don't want to neglect the opportunity to take a tax loss, which we'll get to in a minute. Again, those tax losses offset gains dollar for dollar. That might be a gain this year, might be a gain in the future, especially if we have excess losses this year, right? So you're going to sell business in the future, you're going to sell a highly appreciated stock in the future, and you see losses today, can make some sense to realize those now. If you ran out of dollars of gains to offset with those losses, you can offset up to $3,000 of income every year. So if you're in a 37% tax bracket, that $3,000 offset's worth $1,000. So again, it's on us or you, if you're managing some of your money elsewhere, to make sure that you at least go to bed with a $3,000 loss that if you had that opportunity to realize in the year, right? And the other thing that I'd say with like tax loss harvesting is, we have this kind of mentality at times that we own something, it goes down, and we'll wait till it recoups. Sometimes you just made a bad investment and it's okay to move on. If you can rationalize the sale of it as being a positive versus kind of putting your tail between your legs and feeling like you had a dud, maybe that psychological benefit of tax loss harvesting can spin it in a good way. Here are a couple quick examples. Again, next slide, Matt, if you don't mind. Where tax loss comes into play on the income offset, right? So again, you've got a situation where you have 3 investments, right? If that's the case this year, odds are all 3 of them are up, but let's assume 2 of them are up, one quite a bit, one's a little bit modestly higher, and the third is down. You can go ahead and take the loss on the third one, buy something that's pretty darn close, and that loss helps offset other income. So you made some money there on top of the first 2 investments that made money. Your net effect here in a 24% tax bracket, hey, you might have an extra $720 that you don't owe come tax time or in your pocket. So that's the, hey, $3,000 are being offset by losses. The next slide is the more traditional way, which we see this, which is the capital gain offset. So again, same investor, you get those 3 investments. The first is up quite a bit, the second's up a little bit, and the last one's down. The one that's gone up a lot, if it's gone up a whole heck of a lot, right, you might want to be in a position where you're taking a little profit and you're selling the third investment. Maybe you're buying more of that third investment's asset class because now it looks more attractive, or even if you're just buying back the same amount, but you took some of the profits from the investment that had gone up a lot to buy something different. You're creating or maintaining discipline in your portfolio. So we say, tax loss harvesting has a, kind of a multiple benefit approach, not just simply one. One thing I want to call out too, Matt, if you want to hop to the next slide, on the basis of the tax loss harvesting, there's a big misconception out there that it's always kind of a situation where you sell something today and you could always buy it back in 31 days, and that creates a little bit of risk if that thing you sold has jumped a lot. We'll do some double down transactions, which says, hey, I've got 100 shares of a position that's got a loss. I really like the company, but I like the loss. I'd like to take the loss. So if you have the capital, you might buy a new 100 shares today. Essentially, you've averaged down your basis on those shares. And over the next 31 days, you need to wait these 31 days. If you're compelled to sell the stock, right, because frankly, the loss hasn't evaporated in the first position, you can just pick those lots that had the loss. You have the new shares, which hopefully haven't lost any money. And so you're in the same economic position as before, but you're never naked, right? We've had instances in the past where the doubling down works great. All of a sudden the loss evaporates on the original position and you've got a good size gain on the new position. Hey, not bad making money, right? Couple things again to be cognizant of here. Eventually you're going to pay the piper, right? We realize that. If you think in the future your tax is going to be a lot higher, right? Maybe tax loss harvesting isn't to your advantage, and just realizing the gains today can be okay. There are instances where your income is so darn low, and we've worked with clients who are in graduate school or medical school where their income is nothing, where parents have been gifting them highly appreciated shares of stocks. if your income's under $44,000 this year, they can sell 44,000, they can realize 44,000 worth of gains and have zero tax liability. So it can be a really powerful tool. There's another thing we talk a lot about, like, taxable accounts in theory, the piper will be paid at some point, but the one nice thing, I don't know, so it's nice or not, but like you still have this step up in basis rule, which is in effect when you die. So you could go 30 years, make a heck of a lot of money. The cost basis gets stepped up and no one ever pays taxes on that gain that you experience. So, deferral generally is as good as it gets. Tax-free is outstanding. I'd like to not have to die to take advantage of that. On the wash sales thing, again, don't buy something back in 25 days, right? You won't have the ability to take that loss. And you can't buy something that's identical, right? If you sold IVV and bought SPY or IVV and the Fidelity 500 index, the IRS is going to say not so fast. The good news is it doesn't have to be that much different, right? You buy, sell IVV and buy VTI, which is the total market index. Their tracking error is pretty close, but they're enough different that the IRS says that's okay. So that's the kind of day-to-day trading stuff. For small business owners, right? Like the last few years have been really, really interesting, right? We had the pandemic lead to a massive amount of people quitting their jobs. Business formation was elevated. We think that'll continue, especially with the administration that's going to come in. There's some deductions that have been around forever, like home office deductions, writing off your wireless or Wi-Fi connection. You could make the case that, office equipment, i.e., furnishing your home office, which isn't a bad thing for aesthetics, but also can be deductible. Again, that's a conversation with the accountants. Small business retirement plans, we set these up all the time. Some of them have deadlines that are coming fast and furious here, right? If you want to set up a 401k for the 2024 year, it's got to be done by December 31st. A SEP IRA is something that can be set up as late as you file, come even October of next year for the 2024 year. And a simple IRA is for those small business owners that want to have something that looks like a 401k. In a small business, right, a lot of people are thoughtful about how they pay themselves, right? You can have a salary, which is subject to FICA tax. So you'll pay your Social Security tax up until the limit. And then you can structure the rest of your compensation as a distribution, which can allow you to minimize how much you pay in Medicare tax, right? Because if you're paying all of your salary, that 0.9% Medicare tax will be there with you all the way if you paid yourself $500,000 or $1 million in theory, whereas if you stop your salary at the FICA levels of roughly about 170, you could save that 0.9% for a significant amount of money, a significant portion of your income. The pass-through entity tax and SALT, right? So if you live in a high-cost state or high-tax state, Massachusetts, California, New Jersey, New York, and there are a few others, your state income tax as it relates to deduction or property tax together, either one of these is capped at $10,000, right? So you can appreciate, again, you get there pretty darn quick. If you have a small business, you can opt to have your business pay the state taxes, which essentially are expensed against your federal return, right? So again, let's say you have a $50,000 tax bill you owe the state of New Jersey. If you expense that through the federal return and you're in a 24% tax bracket, 50%, $50,000 against the 24% marginal rate is going to save you $10,000 in taxes. You still could take a $10,000 deduction against your property tax. So again, if you have a small business, you should definitely be talking to your accountant about pass-through entity tax. There's also some other business pass-through benefits that come through as a small business owner, and I fully anticipate further entrepreneurial programs will be put in place as we think about tax reform in 2025 and thereafter. So I'm going to wrap up here. This is uncommon, where I've only taken about 10 minutes at a time to talk. I just want to make it very clear, if you're doing some of this work, by the time it's tax time, it's too late, right? Like, taxes is about being proactive. It's about being proactive yourself. It's about being proactive with your advisors. Rest assured, we are doing that all the time. But again, if you're not asking your accountant to help you with this work, shame on you, right? And accountants are a wealth of knowledge. They're busy for about 4 months of the year. The other 8 months, they're goofing off or have more time. So be sensitive to not asking for some of this help in April or in late October as they're dealing with extensions. Control what you control, right? Like, we can get upset about, the stock we picked or, what Fed policy looks like, or even the election outcome. Again, we did our part. Let's control the things we can control. Taxes are surely a place there. We talk about the two key ones being, taxes and fees, right? the more informed we are, the better off you are, right? Like, it's not uncommon that a year goes by where, we're asking clients for tax returns and like, why do you want that information? I don't look at it as being intrusive. We respect your privacy. It's not for anyone else's consumption, but it's for us to make you a better investor, right? We're not looking to fish around to see what other things you have. We're really literally looking at on the form, where are these numbers, where are there places for us to work? And again, it's these little things can be critically important and can make a big difference, right? And there's the pay now, pay later, when and where that makes the most sense. We'll be the best to give you that. So again, thank you for joining us as we took you through this. I know Tom's gonna kind of take us home, but again, grateful for your time as always. You've been wonderful this year and attending the various events we put together for you.
Thank you, everyone. I don't see if there are any questions. I did capture the client who raised their hand, so we'll definitely be following up with you afterwards. But if there are any questions, please feel free to email us. As always, I'm sure that, everyone's situation is going to be very specific to them. So we're more than happy to take those offline. But thank you, like Jeff said, for everyone who showed up today.
Thanks, everybody.